Hi, this is Pat O'Meara. I'm with my good friends, Dr. Rick Roque and Jeremy Potter, and we are here to talk about the reality of tokenized real-world assets, and specifically the evolution of mortgage banking and RMBS. We talk a lot about CMBS. We talk a lot about alternatives, private equity, infrastructure assets, private credit, tokenized securities. But RMBS is going to be dramatically impacted and is being dramatically impacted by blockchain. So I thought I'd bring on a couple of old friends to talk to me about this. And why don't I start with you, Rick? Why don't you tell us a little bit about yourself?
Yeah, I appreciate it. It's good to see you. Good to see you, Pat, and obviously good to see you too, Jeremy. Yeah, I'm Rick Roque. I'm Vice President of Partnerships at Cross Country Mortgage, the third largest retail mortgage originator in the United States, and I've been a long-time industry consultant. I started a consulting practice called Menlo back in 2009, consulting with many of the largest mortgage originators in the United States and several tech firms aiming to push the envelope on various innovations, whether it's tokenization or blockchain or even the latest innovations around ChatGPT and its implications around just streamlining the mortgage process. Went to college with you, Pat. So that I was going to say 20 years ago, but gosh, a little bit longer than that.
Wow.
And
Yeah.
So no, I'm glad to help you and to talk to you about this important subject. I love what you've done in Inveniam on the commercial side, and I'm sort of biting at the bit, if you will, waiting for these innovations to sort of jump over the residential fence between the commercial yard and the residential yard. It's imperative that these innovations come to market for the purposes of consumer transparency, consumer control, and ultimately consumer costs, and confidence too, investor confidence in the process. But so super happy to be here.
Hey, it's great to have you, Rick. It was 30 years ago that we were in college, and in intramurals, I would say I was owning the Dr. Rick Roque in our intramurals, other than maybe the basketball court. And Jeremy, good to have you, brother. Give us a little bit about yourself.
Thanks, Pat. Great to be here. I'm advising and consulting companies in the mortgage and title insurance space. Right now, I've been working with startups, Series A startups, and pre-seed and seed startups for the last couple of years. I spent a couple of years at Stavvy looking to digitize the real estate closing and asset. So we're going to definitely talk about that, but mostly thinking about how the mortgage product, so credit risk, housing policy, and then product development feed into housing affordability, housing access, as well as then how title insurance and other insurance companies get involved with some of those more, I think for a lot of consumers and maybe even a lot of investors, the more obscure parts of the industry like title insurance. So
Gotcha. And Jeremy, you're an attorney. Tell us a little bit about how you got started in the mortgage business, right? Tell me about kind of your history with mortgage.
Yeah, I was in Connecticut, and the housing crisis occurred, the 2008 crash. What followed was the Dodd-Frank Act. And so I was a regulatory compliance attorney for Dodd-Frank related compliance, helping mortgage companies, particularly independent mortgage companies, adopt all those new regulations, understand what a Consumer Financial Protection Bureau is doing or could do, understanding what those disclosures meant to their business, and then understanding what process changes or training, other things had to actually, happen in the business. And for a young attorney, it was actually a great way to learn the business side, because I had a really good mentor who, had me go around to each part of his mortgage business and talk about the legal and regulatory changes that were occurring. And so I learned the business sitting next to the people who were running the business in each area. And so that's not always the experience of an in-house attorney or even of a regulatory compliance attorney, of course. And so I got hooked and helping, speaking at Mortgage Bankers Association types of events, helping all lenders comply, because regulatory compliance is not really a competitive advantage. At least it shouldn't be. It should be
It's
competing
an
on other.
anti. Yeah, that's right.
And so we were helping the whole industry move forward and modernize and adopt. And I had always been interested and curious about technology. So, not a technologist at the time, of course, but a tech curious lawyer. And so when I got the chance to join Rocket Mortgage as legal counsel, move the family to Detroit, I got to see the scale of residential mortgage at the largest originator. And Rocket became the largest originator while I was there. And that was exciting. That actually led to me being able to step over into the capital markets group. And that's where I led a strategy and product development group. And so I worked very closely with Fannie Mae and Freddie Mac, worked closely with large banks that wanted to buy assets from Rocket, and understanding how to do new things while keeping it within the housing policy goals and the regulatory compliance goals that the industry had set out, years earlier. And so ever since then, I've been, trying to build up other innovators and companies that can support the ecosystem. I think one of the things we'll talk a lot about is just how complex the ecosystem is, and then as a result, how hard it is to introduce modernization and technology, and especially emerging technology. But that was an exciting opportunity for me, and so I kind of fell in love with that challenge and have been running with it ever since.
And Rocket was a transformer of the industry, right? They shook up the mortgage industry completely and totally, reframed it and reshaped it. And we're talking about kind of a next step in evolution of the next technology evolution and transformation across a number of different areas. And we're going to dive into that a little bit. But Rick, let's go to you and your background, right? You talked to us a little bit about the fact that you've been a consultant for a long time in the mortgage industry. Talk to us about, you came out of software and then you went into mortgage. Tell us a little bit about your background. How did you get into it? And what are some of the things that you've been doing through this first real evolution and transformation and revolution via internet, right? And what is that? What was the role you were playing there?
What's interesting is, so I got into the business right when Ellie Mae had begun to catch some traction within the market. I had run a tech company called SGI, which was a CRM company that I had founded with my partner back in 2001. We sold it in 2003 and a half into 2004 to a private equity firm in St. Louis Park, Minnesota. And we rolled that into and the thought leadership around that to a tech company that took loan origination platforms and put them in a Citrix environment to distribute. Because at the time in 2003 and 4, as the industry was sort of flexing, it was all about scalability. It really wasn't about management tracking. It wasn't about reporting. It wasn't really about compliance. It was just all about scale and in origination. So trying to capture sort of the biggest top of funnel opportunities and then to close and fund those loans really as fast as you could. And as the industry started to buckle in 2007, rolling into 2008, right around when New Century went under in the spring, I think it was 2008. There was New Century and Home 123 and ABM AMRO and Washington Mutual, WAMU. These institutions started to buckle, and so I ended up moving my focus and talents over to Calyx software. Now, Calyx, about 70% of all mortgages were originated. Okay, so it was a massive number when the industry at the time was doing about $4 trillion in originations, and so what was interesting to me was when Lehman went under. I think that was September of 2008. About a month after, the American Securitization Forum wanted to pool together all the major stakeholders in mortgage origination to figure out what the hell happened, right? And the ASF is very much on the security side. I mean, it's the American Securitization Forum. So they're on that side of the fence with very little at the time, and really even today, very little of their view and tentacles and really involvement on the front end. At a time when all the issues within the origination space was on the front end, okay? Whether it was poor document collection, document validation, and then even sort of validating the work that had been previously done by underwriters, closers, and funders. There was just no automation on that side of it, but the American Securitization Forum was basically taking whatever it was that was being thrown over the fence, okay? And the only thing at the time was MERS to basically register the ownership of that particular note. And that was really it. And I was talking to Jeremy about this, where MERS was pretty innovative at the time. It just simply, it at least created sort of a white pages or a digital or a registry for mortgages that were being funded. But it was
let me interrupt the flow real quick, just because you used a couple pieces of jargon, and I know that there's people listening who are not aware of some of the things that you've mentioned. Ellie Mae, whatever. What was MERS, and what did it do? Does that make sense? I mean, you were describing it, but where did it come from? What was the origin of the innovation, and how did it get distributed?
At the time, it was just a way to create an electronic registry for mortgages, and in essence, the funding data, who owns the notes, and it wasn't in any way to create like an e-note. It was mainly just to create a way of registering the actual loan that a lender had funded. I don't recall when MERS started, Jeremy. Do you know? Was it 2001, 1999, 2000, 2001? Not to put you on the spot, but I wasn't sure if you knew what the origins was.
I don't know the creation, of the entity. I think the real value, though, the real kind of explosion where it became the utility, the industry utility that it is today, was as a result of the crisis. It was when lenders and servicers couldn't find the note or couldn't find the chain of how it had been assigned or sold. And as a result, there was actual, missing pieces of documentation, missing pieces of information about the owners and servicers of these notes. That was, I think, when it became the go-to place that we've seen in the last 15 years.
Yeah. Because to your point, Pat, in the rise of the internet, especially in the mid 90s, it was just all about connectivity, right? Ellie Mae had acquired a technology called ePass, which at the time was an innovation. I believe Scott Cooley had invented this with the loan originations platform called Contour, which was popular in the 90s. And it was mainly just do this wild thing. Within this form, click a button to pull credit, or to pull or to request the appraisal to be ordered, and actually have that order to be electronically submitted to an appraiser for an appraiser to actually perform that function. Okay, it was just an interconnected way. Ellie Mae called it ePass, and Ellie Mae was just another loan origination platform. There's dozens of these platforms, but at the time in the early 2000s, there were probably 10 or 11 that made up about 98% of all originations. But ironically, Calyx originated 70%. So of 100% of all the mortgages done, about 70%, about 68 to 70% were done by Calyx software. And then of that remaining pie, that 30% pie, was a splinter of about 9 other loan origination platforms, of which Ellie Mae was one. Now, at this American Securitization Forum meeting in October of 2008, executives from Countrywide and Wells Fargo and Bank of America were all in the line, and it was essentially saying, how do we rapidly get access to the front end? How do we get access to field level validation to understand whether or not what should be done on the front end, it was supposed to be done on the front end, right? And really, my comment to Jeremy last night was, since that conversation, not a lot has really changed, right? The only thing that's really changed in mortgages and the way mortgages is done is really smart PDFs, maybe some OCR technology, optical recognition, character recognition. There really hasn't been any real shifting. We've done things faster. We've done things cleaner. and with the compliance shift with Dodd-Frank in 2012, 2013, the reality is there's been a lot more for us to do, but there hasn't been really a great deal of innovation to do things differently other than to collect things faster and to try to do your best validating it. But it didn't really reduce headcount. In fact, headcount went up, and so my intersection in this space was mainly how to drive these innovations forward, right? So my background was always on the business side and on the technology side. So as I did mergers and acquisitions, as I expanded retail platforms, the question was, how do you sort of scale and ramp an organization? But we're pretty much using legacy systems that were built in 2000, 7, 8, 9, 10, 11. Ellie Mae's Encompass platform, it's a great solution. I wouldn't consider the best technology, but I would consider it a great solution because of its interconnectivity and its adoption throughout the space. But still, that platform hasn't really fundamentally changed since 2009, 2010.
And Rick, is one of the things that we're talking about here, which is super important, is we're talking about a networked world, right?
Yeah.
And historically, securitization is where this networked world becomes funneled into a single pool or trust, right? That gets rated, and then it gets distributed by something on the back end, right? And what we're talking about is how do we, on the origination side, collect data and deliver real-time delivery to funding sources where some of those intermediate functions get removed, and the legal function, the middle function, right? The legal middle function, the trust function may remain, but the middlemen get removed along the way because technology is delivering funding directly to the types of mortgages that are being originated on demand, real time, right? And there's two sides, right? This origination, and I'm going to go, from my crib notes, right? I'm in your world, but Jeremy, I'm going to go to you, right? Point of sale, application, underwriting, closing, funding, loan delivery, and quality control. All of that is one side of the fence. And then Rick was talking about what gets thrown over to the other side. Then you have securitization and loan servicing, and you're talking about a different cast of characters. And what we're now talking about is how do we consolidate it where the originators are owning direct connectivity to funding sources, not only for warehouses, but long-term funding. You know what I mean? And where you have investment banks who are structuring RMBS, and that RMBS is going to be a trust that might own, but that trust is defined not by a preset number of mortgages that are discrete, but an algorithm that buys on demand, right? And it buys on demand and funds immediately into instantaneous long-term ownership. And we're talking about end to end. Instead of throwing it over the fence, the person who's buying is seeing all the way through to origination, right? How are we going to see that adoption and connectivity of step by step by step by step? Because Rocket, brought real innovation and origination, right?
Yes. I think one of the things that Rick's talking about that has kind of caused the industry to lag in terms of the modernization adoption path that you're forecasting has been that even though digital tools or digital solutions were brought to certain parts of that chain, they were done incrementally in a piece. And as a result, the order of operations never really changed. So even though digital technology was introduced, the way in which information or the step-by-step process kind of stayed the same, even though each little piece got faster. And what Rocket did that will, I think, really help drive the next innovation was go directly to the consumer and say, through the web, through technology, you put in your information, you upload data. It still was PDFs, but at least there was one step forward. You put it in instead of having to go get it somewhere else or in the physical world even. And now we've got technology that's going directly to the data source. So then Fannie Mae came along and said, hey, we'll give you an incentive as an originator, and they call it day one certainty. The incentive is use a single source of data to deliver the loan. So instead of delivering us PDFs, deliver us the data from the consumer's checking account, for instance, showing what they make every month or proving some of the things you have to prove in underwriting. And so one of the trends in innovation that we're seeing is how do we find ways to pull that process farther up, secure it earlier, and then cut out all the delays, all the rechecking it, all the redundancy that you mentioned, because we can now drive directly into the source data, the consumer's financial information or the collateral record on the house, and then drive those directly to the investor. That's the dream. The only way you can do that, though, is if you have clean data sourcing. First off, how do you get it in? And then, to your point, locking it into that verified, trusted place that the investor can look.
Yeah, and when you look at the software that exists to validate performance data inside an RMBS, it's unbelievably bad, right? Like, I mean, unbelievably bad. It is 1995 state-of-the-art technology, right? And you know, I joke with people that the most efficient market in the world, you know, take Bitcoin aside, right, for just 1 minute, maybe behind that is, you know, the taxidermy market, right? The secondary market for a moose head is way better than the secondary market for bonds or anything else. And the reason is, I just, you know, and I've used this example many times, you know, 30 years ago, my wife says, get rid of the moose head, right? I go, I put a sticker on it, put it at the end of my curb, and I hope somebody drives by. And eventually after a week, it says free to anybody who wants it. Now I can go on to eBay and I can say moose head, and I see the clearing price for a moose head. I can look at the quality of those and I can price mine and it goes away, right? And so I, as the consumer and the issuer, can see your clearing price. You've had a lot of different people who have started giving clearing prices. They're trying to go to the customer and doing that. But when a customer maintains their data and they maintain this over time through the life of the loan, and people can see, oh, this person's moved 5 times. They're going to be selling in the last 10 years. They're going to be selling it in 2 years. No, they've been in the same house for 30 years. They're probably not going to move again. And then you marry that up with how many times have they refinanced in the past? What is their credit score? What is their income? What are their net assets? They marry that up. And then people are vying for that customer who owns and maintains their data in order to maintain the lowest cost, instead of trying to get through a system at a single point in time that you're managing to. Does that make sense?
It does. Yeah. Yes. I couldn't agree more. That because the data is somewhere for all of these points that you're talking about. This isn't a situation where you have to go create it. Typically, this is a situation where, hey, it already exists somewhere, particularly with an existing homeowner. They have a record. The question is, how do you access that record in a better way, in a better time, to provide either the proactive offers and insights that you can get, like you were just referring to, or at a minimum, you have a head start and all you have to do is update from the last point of entry. And so either way, you're looking at tremendous speed and you're compressing what is a very costly timeline today.
So when we think about MERS, right? And Rick, you were talking to us about MERS and what that is. It's an electronic registry, right? That is what the distributed ledger is, right? It is a ledger, but it just happens to be public, right? And the person at the end can own their own node and own their own information. They own it and they deliver it real time to whoever they want in a distributed data economy, instead of somebody using that information and they're servicing and the majority of their revenue comes from something other than doing a service, but rather owning data and prostituting that data in other, you know, for other economics. And putting that data control of somebody's own privacy data is in line with GDPR, CPPP, you know, data sovereignty, which is a reality. Rick, how does blockchain and owning your own data, connecting that data to a mortgage that you're willing to participate in and you can see that takeout, how does the MERS public database where are we seeing people actually use blockchain that's working today? You know what I mean?
Yeah.
In a public registry. And what do you think securitization is going to look like in 5 years from now?
Yeah. Well, I think the issue now is that the environment that you've described isn't MERS. Much of the blockchain activity has gone sort of around MERS, not probably to any fault of MERS itself. I just think the innovation has grown around it as opposed to in and through it.
And replaced it.
And replaced it, or at least it's just sort of challenging its important role. I did look up that MERS started in 1995, but as the evolution of the internet occurred in the early 2000s, and then of course, oftentimes compliance it just happened to be the right tool at the right time during the crash of '08 to satisfy a pretty critical need of just keeping track of these digital assets, or rather these notes. But I think the use case at one time has sort of has grown above and beyond it and around it, and they just, at least from what I can tell, haven't really, they've sort of competed against it more than they've really sort of innovated with it. Look, the reality is what blockchain does is it provides back-end investors visibility and confidence in the data, but visibility to the data at the very point in time in origination, right? Provided that the consumer, permits that visibility. Because as of right now, I could originate a loan, I could process a loan, I could underwrite that loan. I'm collecting all of these documents manually. I might be doing, one out of every 6 file audits, manual audits, maybe even some technology related audits. But to save money, I'm not going to do every single file. I might do every 10th file. All of that activity is being done completely in the dark and in the shadows of the investors who are actually buying rights to that asset. Okay. What blockchain does is it provides visibility in sort of a dashboard view of the quality of that file from the very point in time you pull credit, at the very front end of the origination process. And so it really, if anything, it tears down just the traditional pillars or the traditional walls between sort of functional segments, and it just streamlines it into this clear view day of what's coming in, down into the horizon of origination. There's tremendous value in that, and I think the studies around this have indicated that just with that kind of quality, confidence, and transparency, there could be anywhere from 85, 90 basis points to 160, 170 basis points or more of liquidity that's just unlocked, that's just built into the fear of the transaction, that all of a sudden gets unlocked in the transaction as a result of having that kind of transparency. The issue, I think, with the obstacle with blockchain is that there's value in being the middleman, right? If you're the middleman and you're getting squeezed on the front end and on the back end, the control that you have in the middle gives you a sense of value, right? And so to some degree, you almost have to, so the more walls I build, inherently the knee-jerk reaction is I'm creating value for myself, not for the consumer, but for my entity or my enterprise, because I have the data, right? I have the information. What's it worth to you, right? And it becomes a very counterintuitive game that if you end up, in essence, reducing your perception of what makes you valuable, and you redefine that around the actual transparency and accessibility to the information that you're collecting, all of a sudden your value triples.
Yeah, owning the customer journey, owning origination, owning the customer relationship, having the brand that can process end to end. Jeremy, you were going to jump in. I jumped ahead of you.
No, Pat, I think I just had 2 quick examples that I think illustrate that, because sometimes it's not even out of like fear or resistance to change. It's actually just kind of human nature, right? Like take the custodian, for example. This idea of an e-note needs a custodian and needs a vault, but it's data. It's pure data. And what do we do in this industry? We set up something that looks and feels like a protected basement of a large bank digitally, instead of actually treating the data like data and creating a new custodial process or a new vaulting concept. We just replace the physical room in the bottom of the bank with the idea of a digital vault, and we call it an e-vault. And that's innovation. But to your point, and to the point Rick was making, those are the groups that should be threatened by this, because you don't need that concept or construct. You still need the legal concept of a custodian, obviously, but you don't need that same kind of physical representation in the digital world when you have the, networked back end that mirrors the networked front end.
And I think one of the things that's going to happen is, when you talked about the financial crisis and there was the adoption of MERS, right? They had the technology, internet helped it. One of my favorite examples of this is, when 9/11 happened and they stopped all the planes from flying. One of the things that they were still doing at that time is they flew checks back to the Federal Reserve that check had been written from the home bank, right? That worked with that region of the Fed. And so every check was flown every single night. Mm-hmm. And all of a sudden they realized everything was processing. We don't need that paper check anymore. Do you know what I mean? And yes. And it wasn't until 9/11, even though they'd been doing it electronically for years and years, that they said, okay, the process is being disrupted, right? And they did away with that. I think that as we go through this pain and suffering, and people need to get through a changing interest rate environment, significant inflation, we're going to see people reaching all the way through to the customer and are going to say, I am willing to lend you money directly inside a trust, right? According to these terms, if you're willing to do this. And we're going to start talking about people owning journeys, and the relationship of origination is going to change. Rocket did that, right? But when you have people like Redwood Trust, who was an investor in Oasis Pro Markets, they are issuing tokenized bonds. Redwood Trust is one of the largest RMBS players out there, and they're doing this, and they are now playing where they own digital instruments. The next step for them to connect that up and skip the investment banker who's been doing that securitization, and they're saying, we're going to do that electronically, algorithmically, is pretty easy. And then when that data is connected and you can see it real time and validate it, that's when you can start using things like AI for audit. You can, there's a whole bunch of functionality that happens. So the big question is, when is this going to happen? We know Lou Ranieri, and a number of other very famous people went in blockchain servicing a little bit. They made a specific chain choice, always a bad idea, always bet on blockchain in a chain agnostic manner, where you can go one back and forth. And that slowed them down quite a bit, but they're still working on that project. We know some other people are in this space. But when is this going to become a reality?
Yeah, I think that the areas that you just mentioned that are most moving the fastest is the consumer data. So everyone is looking at how do we bring the consumer data, reduce it to a token in their control, right? So you have companies out there like Form Free who are saying, hey, we can do that already. We want to do that already. Let's try that. That takes part of the underwrite, brings it into the consumer's control and says, okay, click go if you'd like to have lending offers using your data. And then we have to have the same thing for the collateral for the house. So bringing the appraisal data that Rick mentioned, bringing the title data for that house, bringing that up front, loading it in with the real estate data. So think of folks working on this like consortia, bringing that up to the listing. So now you have the listing prepackaged for the house and you have the consumer data prepackaged. There still is that moment, though, of local compliance. Because this is a municipality-based agreement and transaction, somebody still has to build the digital closing moment where the legal rights attach and get reduced and thrown back out to the town records. That, I think, is the key. And so that due diligence that you're talking about is instantaneous on the data at that moment. But that is one of the bottlenecks that, we're probably still I'll defer to Rick next. I don't want to take up the whole answer, but probably a couple of years. We're a handful of years away because those two tokens have to get brought into that kind of legal consummation moment because of the local nature of this transaction. And then the due diligence can happen instantly at closing, which is transformational for the investor that you're talking about.
Yeah, and when we talk, so Proppy, I want to give them a shout out, right? They've been working on this for a couple of years. They've been working on closing on-chain, real-time, a ton of money. Michael Arrington has backed them. They're doing a lot of great work. But they are for that title going in, and then the creation of the mortgage note that then gets turned into a security and put inside. And so that middle function, a lot of that can be done electronically, but it needs to be structured, set up where it can be done at scale, and the asset trades hands, the title insurance is there, think Proppy, right? And there's others in there working at that, and I don't mean to just highlight them. But as we do this, RMBS is a massive business. And Rick, you've talked about 160 basis points, and I would suggest that 160 basis points covers over a lot of sins for the bad credit. You know what I mean?
Oh, yeah.
And misprices the good credit, right? So talk to me about how pricing is going to get more appropriate, right? What is this going to do to RMBS?
Well, I think pricing is the veil will have been ripped down from how pricing is actually made. The pricing right now is so speculative and risk-based, and it's not really built. It's driven more on fear than it is an anticipatory fear than it really is on the data. In what blockchain does is it gives you the data to actually provide more real-time, accurate pricing that you could base your forecasts on. Pricing is such a complicated subject because it is so arbitrary based on the secondary desks in every mortgage company in the country. It almost becomes more of a cost exercise based on how much you need to make than it is a top-down, a market-driven exercise based on what the value of that instrument is once it's funded and sold.
And Rick, isn't that truly the revolutionary thing here, which is private capital, ever since the crash, private capital has felt as a significant disadvantage to Fannie and Freddie because Fannie and Freddie is seen as so efficient that they can just clear at a better price than private capital really can. And so jumbo above Fannie and Freddie is really the only thing we've seen. But what Pat's saying and what you're saying, I think, Rick, is that when you actually use more data and you use it in a better way to understand true risk-based pricing, not market liquidity pricing, right? Fannie and Freddie is really pricing for how easily it fits in an RMBS, how easily it fits in their securitization, not necessarily the risk the consumer can pay back and will pay back the mortgage. So private investors actually have an advantage because they can actually look at what is pure risk-based pricing when you have the right data.
Yeah, and I think as we think about, I want to think about two things, right? I want to think about this evolution of the market, and I want to think about the last 20 minutes of this podcast, right? So I want to say, hey, everybody, get your questions in, give us your thoughts. But I think one of the things that we need to talk about is, Rick, in your unique seat at cross country and partnerships and the evolution of where you're going and how mortgages are going to be originated and how you're going to connect out to the kind of the end-to-end life cycle of the mortgage, you're in a fantastic seat. Jeremy, you're in a fantastic seat. The question is, who are the individual companies that we should bring onto this? And I'm going to ask everybody who's listening, direct message us, email us, go into the comments of this LinkedIn and say, here's the company. And I'll offer to the folks at Property, let's have another conversation where you're in on this call, right? Are there other people we don't know? Let's bring consortia in on this call. Let's have it where we're talking about how do we do this and how do we bring some major players together and drive this. Because what we don't want to do is just, pontificate. We want to drive outcomes where we have a data operating system in a decentralized environment Inveniam, right? That was our sales pitch. Sorry about that. That powers these things end to end, but literally where the players who are bringing this innovation are sitting in the conversation and saying, here's where we're making progress. Here's the obstacles. Here's what we're delivering. And so Fred, you guys at Redwood Trust, you made the investment into Oasis Pro Markets as a great partner. How does that fit in with Proppy? How does that fit in with consortia? How does that fit in with your data requirements? And then how do you start funding at scale into what you're doing, where this looks like blockchain, right? Whether it's a HELOC, whether it is a first mortgage. And so I think what I want to say is, A, come at us with questions if you have them. B, send us who you think are the players that we need to bring in for conversation number 2 here. But I'm going to go and say, Rick, Roque, who do we need to bring in order to make this a reality? If you just say we need to put 5 people in a room, and these 5 people will bring that change, right? Who are those 5 people by type or by name or by company?
Well, I think you back into the answer to that question around where it's not, right? And in blockchain today is really it's a non-agency. There's really a non-agency benefit today, right? Because 2 or 84% of mortgages today are, I think, are agency or conventional products, and then the balance is FHA and VA, and then there's a really small piece of that pie that's non-QM. And I think that the non-QM piece of that pie is probably the easiest and lowest hanging fruit to go after, because that's the closest to the commercial line. It's almost regulated similarly to the commercial lending, in that the regulation's simpler, it's more streamlined, and so I think it's hard because I don't really see, I mean, there's a lot of smoke and mirrors in a lot of the tech vendors today around the discussion of blockchain, because they talk about blockchain, they talk about these new innovations, and there's really no roots to the solution. It's not blockchain at all, right? So I'm hesitant. I mean, there are some bona fide players out there. Redwood has done, especially on the jumbo side, has done a phenomenal job, I think, in being a thought leader in the space. Form Free, that Jeremy had mentioned earlier, I think has done a lot of really good in sort of advancing the conversation. But the actors you'd expect to be at the table and trying to sort of drive that, I think, are so busy and so entrenched in the legacy way of doing business, you don't really see a lot of the innovations coming out from them. The conversation, and Jeremy will talk more about, I'm sure, about Fannie and some of the agency discussions around this, but I don't see a lot of thought leadership coming out of the institutional partners that really need to have a seat at the table.
Go ahead, Jeremy.
Pat, I was just going to say, I think the thing that was exciting when I met you and when I started working with Inveniam was that we had a proof of concept. We had it working on the commercial real estate side. And so you can say, okay, let's see how this maps over. And so one of the groups that we haven't mentioned that I think is really interesting is working on home equity. So I think you know the team at Homium, but this idea that you can buy home equity and you can try it in a smaller asset size or smaller asset class. And so we've kind of looked to commercial as a leader in the space. Now we're looking at home equity as a way to fractionalize the asset. And then can we bring that over to the first, you were saying about the first mortgage. And I think being able to look at something that's working, bring over what works, look at a little bit of a smart, I'm not afraid of incremental progress when it looks like that. That's a different incremental progress than what we were kind of complaining about earlier in this industry.
I want to say 2 things. Genray is another name that I would throw out there that's doing this, along the lines of Homium, who I think those guys are really smart. But in addition, we have a question from Brock Cassidy. Tom, if you could throw that up on the screen for everybody who doesn't know, Tom is the guy who orchestrates these podcasts. And so the question is, do these technology shifts allow more live ongoing changes to risk and profit of the loans, as well as the borrower's financial life changes are made to the underlying home's condition, et cetera? And we talk about floating rate loans, and the floating rate is in relation to an interest rate market that people have no control over. But when you can tie to a credit score, you can say, hey, listen, if your credit score is in here through the life of the loan, this is your rate. But the moment you drop, and monthly we're pulling this data, and that's going to impact people saying, hey, listen, if I buy this car that I can't really afford, my home loan interest rate's going to go up. And that's where this functionality and innovation comes up. So Brock, great question. But Rick and Jeremy, either one of you want to hit that?
Yeah, I mean, one of the big things for me around adoption is incentives. And I think we've seen lack of adoption because the investor, the actual customer at the end of the line of the MBS, doesn't see or doesn't feel a lot of the incentives when a mortgage originator modernizes. Or maybe the mortgage originator doesn't feel any incentive to modernize because it's not being incentivized from the investor. And so I think what Brock's talking about is a really strong way to get the adoption hook into the primary market, because the investor is seeing the tangible benefit of how that asset lives on in their portfolio, instead of what Pat, you referred to earlier, is kind of that binary world. If something in the market changes, you've got to refi, or you've got to take out another product, and it's super expensive and redundant for everybody. The investor loses that loan. The consumer pays a lot of fees to access liquidity. And here we're talking about an investor who gets to keep that relationship through data, and then the consumer who gets actually what they need at the right time.
Yeah, and literally this is built for DAOs, right? Where participants can play alongside the ability to securitize credit, which is a changing profile, as well as interest rates, which is a changing profile, right? And all of a sudden, how do we begin to do this? And I think, Rick, you made the comment, a lot of these big companies are not embracing solutions, right? I'll give one of the biggest blockchain companies out there for real assets that has the word block in their company. Literally nothing is on the blockchain, right? They have no wallets connected. They have one smart contract that has done three transactions in the last year. We watch them every now and then because they make big announcements, and literally nothing's on the blockchain. You know what I mean? It's all in a centralized database. And you say, okay, that's great. They're making some progress and they're making some money. But the reality is the promise of a decentralized solution is never going to come through. And the benefit of network is not going to ever be born there. And we need people. And so that's when we say it might be USDC, it might be Circle, it might be Galaxy Digital, it might be Coinbase, who are delivering stable coin assets, right? The killer app of blockchain so far, that, right now there's 130 billion that are saying, I want real assets. And we say, okay, listen, come in, we'll connect you as a source of liquidity to community banks that still need to lend to people to buy homes. Do you know what I mean? And we're going to connect that up directly digitally, and we're going to connect that. And there are service providers. FIS is talking about this. They're talking about it in a major way, right? Coinbase is talking about this in asset management, I should say. Coinbase Asset Management in a major way. How do we connect these things using Inveniam as a data layer where we can connect this end to end? And the player might not be B of A. It might be Circle. Do you know what I mean? It might be this Go Network. It might be Tether. It might be, I hate to say that out loud, it might be BNB, Binance, right? Where there's huge assets sitting there that are the ones who are all of a sudden, it's where liquidity is, because we got $5 trillion sitting in money market funds because they don't want to take the enterprise risk of a bank while they still get exposure to those loans, right? And so how do we get them those vehicles? Sorry, that was a really long monologue that I was hoping one of you would jump on top of and come back with. But go ahead, Jeremy.
I didn't want to cut off Rick because I feel like I've been doing that already this hour. But I think you're exactly right that I want to go back to what you said about eBay and making a true marketplace there. When we think about who wants the risk that we've been talking about, it is large long-term investors, and consumers want to be paired with long-term investors too, because that's where the 30-year mortgage came from. That's what keeps monthly payments low. So when you think of these large insurance money managers, these large institutional guys, and then you also think about what could be possible when you expose that same long-term benefit to groups of consumers directly through a funnel, you get a ton of capital who wants this exact profile. They want to build communities. They want to help each other. You think of pension funds want to help the pensioners and the people in the industry that they support, that their whole lives have been about. So connecting them unlocks all kinds of product development opportunities too. That's the best thing about bringing more data. One of the things I like to say to Rick all the time is more data always wins. In every industry, if you can open the aperture and make it faster and easier to get more data into the analysis, that will win over time. And
the only people who hate that are the incumbents, because they're winning off of data asymmetry, right?
Right.
Well, correct.
And so they have to move to that open environment. Go ahead, Rick.
Well, I was going to say, that was my point earlier about the, the perception of value and the perception of power and your role of the middleman, because those are the incumbents. They're the power. The existing power sort of brokers are ones that control the fences. They're not the one, and they're not the ones that are eager to tear the fences down, right? I think, Jeremy, you're spot on. I think the challenge is financial services as whole is so segmented in the community at large, right? And so we're asking legacy players, like especially on the investment funds and retirement funds and very, very large institutions that are in some cases 100 plus years old, who's really have never been in the mortgage playground. Right. And so I don't know how you bridge that gap. Right. I really don't know how you somehow pull them into the game without, and I'm trying to be sort of agnostic in my comments because everyone has their own, and the mortgage product space is so niche and so narrow, and it doesn't really cross like, the collateral does, but the leadership and the experience don't, and the relationships don't.
Yeah,
it's not like Rick, these aren't people we hang out with at conferences.
Yeah,
so those relationships aren't being built.
So one of the things that I want to say, we have about 8 minutes, and Rick, I want to thank you for participating, and the fact that you are sitting in a seat at the number 3 lender in the country, right? Mortgage originator is that's an existential evolutionary function. And you're moderating your comments extremely well, and I appreciate your participation. But I do think that this has to happen, and I will tell you, I was at a series of conferences, Coinbase's, the State of Crypto and the State of Digital Assets last week conference, and also the Galaxy's conference yesterday, and they were bringing traditional and DeFi people together for the first time, right? So these are the large asset managers, and we're in the tokenized real world assets and what's going to happen, and what the people conceive of who are technology only, that's going to replace the existing thing, versus the real world participants. The incentives are not aligned, and they're not really scratching the itches. You need participants who have enough knowledge, who are going to say, I'm going to evolve, and I'm going to go from number 3 to number 1. I'm going to go from number 10 to number 1, right? Not somebody who's going to go, I'm going to go from number 10,000 to number 1, right? And so how do we drive this with the people who are there? And I think we're going to see new partnerships when we start seeing loans funded from with USDC, right? And I use the LSEG, London Stock Exchange, when they bought Refinitiv and they went all in on the data play, and their new logo is LSEG is open. The London Stock Exchange was the ultimate closed society. Do you know what I mean? To get a seat You were a player. Now it is open. It's all via APIs. They're selling it. They realize that that's how they're going to win as to be the global exchange long term. This is why ICE, who was just a little nothing player, ended up buying the New York Stock Exchange, right? And all of a sudden you look at these and you say, ICE owns the New York Stock Exchange when the New York Stock Exchange could have crushed and bought 100 times over ICE 5 years earlier, but ICE embraced the data and NYSE didn't, and so now ICE now owns them, right? And so you look at this and you say, data wins. Who are going to be the players that reach in? They're going to deliver it in a market like RMBS. How does somebody like Redwood Trust bring their expertise to go become a dominant player and expand the vision of who they are, right, Rick? Right, and I think that's what you say. And we gotta cross-pollinate some of this functionality. And there's innovators who are doing it, but they need sponsorship, right? And that's the Proppy, that's the Homium, that's the Genray, that's Consortium, that's a whole bunch of other people. Open Form. Did I say that right? Open Form, is that right?
Form free.
Form free.
Form free.
They're form free.
And you're touching on the key, right? So we talked about incentives. We talked about what incremental progress is happening. And I think what I'm hearing that needs to happen is that interoperability between these players. So I think when that is an easy on-ramp or an easier on-ramp to be able to expose, your team, your data to the closing platform and due diligence platform that instantly turns it into an asset for the investor, those kind of like interoperability moments are the thing that'll be kind of that last step of adoption beyond the incentives and some of the progress we've talked about.
Yeah, Rick, give me your final thoughts, brother, as we come up on the hour.
Well, I was just thinking about your question a few moments ago to Jeremy around what the forecast is and how many years for blockchain to adopt. I mean, I think that the non-agency products I think are going to be a lot easier to adopt. So it's not a function of adoption because there's adoption now. It's a function of scale. And the question is whether or not the guardrails of agency products will get dropped in order to adopt, blockchain sort of solutions and partners. The biggest challenge to some degree, the front end are easier solutions as far as collecting consumer data than it is on the back end, especially related to the title in the node itself. There's 3,000 or so counties across the United States. And if you don't fill out the form correctly in Mercer County in Princeton, West Virginia, Betty Sue is going to say, no, I'm not registering the deed. And in my little filing cabinet that I'm manually going to put it in there. And so doing this county by county and getting each of these counties on either an analogous chain. One comment from an executive from one of the top 4 title insurance agencies was, what is everyone going to be on their own chain? Because that's the way they're going to want it. Everyone's going to want to build their own.
This is where that analogy breaks down, Rick. Right? When I was at Bear Stearns and was managing tech in the 90s, I could tell you the difference between Owen Corning fiberglass and Northern Telecom fiberglass. I could tell you about bounce rates and refraction rates and the mirrors and all that kind of stuff. Today, no one cares. Literally, no one cares. You don't know the brand of the fiberglass that this webinar is on, and we just don't care. Nobody's going to care in 10 years what the chain is. No one. We have to be chain interoperable, right? And when people start saying, I'm going to own my own chain, right? Bear Stearns, we used to say we had our own VPN. And then we figured out, the internet works just fine. We'll use that one, right? Does that make sense?
Exactly. 100%. And you kind of went exactly. So that mindset change took how long? 10, 12 years between, the evolution of the internet. I mean, I would say somebody asked me last night, where I thought blockchain technology was in relation to the way the internet evolved. And I say we're 1992, all over again with blockchain, right? And it took probably 8 years in order for American Online to kind of, between 95, 96, 97 to actually get connectivity across the United States. There's going to have to be that kind of, instead of consumer connectivity commercial connectivity with these municipalities, right? That, you know, there is no, without municipality sort of involvement in deed registration, the chain inherently becomes not less valuable, but it becomes handicapped
less
until that
adopted.
problem is
It
solved.
becomes less adopted, and that's
Yeah.
a friction point that we'll overcome over time. But I'm going to say AOL worked because everybody got a disc in the mail, right?
Yeah.
I mean, you got a disc in the mail, so they were using, you know, kind of old analog in order to get into digital, right? And that you got a CD,
that's
and
right.
then you loaded it, and you got it, and all of a sudden you said, okay, here's what, and they mailed tens and millions of those discs. And I want to say, I think that we're going to have title insurance that's going to cover that up and pay a human being to go make sure the title's registered correctly. You know what I mean? Like, we'll just pay a fee for that until it is digital. Jeremy, go ahead, brother. You have the final word.
Well, I am excited that we're having this conversation because I think the larger kind of economic environment is creating the situation where these new ideas can flourish. So what I mean by that is, you were asking about, you know, the final thoughts. I think there's enough people in enough low rate first mortgages in their home now that the demand from next generation buyers like millennials and Gen Z, and the demand on the investor side to find new ways to connect to them is happening. It's hard to do that when interest rates are 2.75 on a 30-year fixed. And I think we're getting to the point now where those that believe in this technology are now being met with those who just have the market need that demands it. And that alignment's really exciting. So that's where I'm betting.
Yeah, and when Circle says, pay me in a stable coin, my mortgage, and I will subsidize your mortgage for you to become native in a digital instrument on my platform, that's when we're going to start to see massive uptake, right? Hey, Rick and Jeremy, what a pleasure to be with you guys today. Thanks so much. This is the first of a couple of conversations we're going to have on RMBS. I'm certain, Rick, thanks for taking time out from being on vacation to be with us. And Jeremy, great seeing you, buddy.
Thanks. Good to see you, Pat. Thanks, Rick.
Take care, Pat. Take care, Jeremy.